Hey, Mr.
Hey,
Greider.
hey, good morning, Albert.
Sir.
Gosh, what a reflection day. I got up and I was, real kind of early because I wanted to see how the CPI numbers and then some of the job reports that were coming out. Then I just looked at TV and I looked at the date and it was 9/11. And so I just had to sit there and kind of look at, I remember that day, when that happened, we had coworkers that were in that one of the buildings and just a reflection of 9/11 that I had. So I had to pause for like 20 minutes and just like, it affected a lot of people. And we still see that today, right? So, um, going to the airport, right? The TSA, kind of see that. And I can remember, yeah, kind of remember why they kind of put some of that stuff in. I'm not going into the political things, a lot of that, but there are a lot of lives affected by that's good to remember. Um, so as we start today, that's kind of my first thing is that you kind of have a reflection on that. Then we're looking at the economic news because that's been up and down. I mean, I think everything since COVID. Man, I'm telling you. Um, I looked at the PPI report. Oh, it looks like inflation's coming down, this, and then the CPI report's a little bit on target of what I say by that, meeting expectations. And then some of the jobless claims came out that was more negative. That was a big number. And so when I look at the two mandates that the feds have, right, the inflation and jobs or employment, I think they're going to have to do something, but I don't know what. Right. So as we get into this DSCR, we're going to try to keep it to 30 minutes. So it's kind of more of a high overview. Please, everybody, put in the chat any questions you have regarding programs, products, or market conditions. I'll answer any or try to answer any questions you have. So Albert, with that, I think we should go ahead and get started.
Absolutely, and thank you for that, Mr. Greider. I appreciate your words about, remembering, right? Remembering everything that happened and where we were, on that day. So, with that, thank you everyone for attending another webinar here with us at Home Express. We always appreciate your participation. Today, we're going to be going over, the ultimate guide to DSCR. So, if you ever had any questions about DSCR and, the program and understanding it and really, getting behind it, this is the webinar that you want to be at because we're going to be addressing all those things for you. Okay, so as always, just like I mentioned, we thank you for your participation. Some of the things that we're going to be covering today with you, right? We're going to be talking a little bit about program history. We're going to be talking about some highlights, understanding the states, a little bit of licensing. Where do you need a license? Where you don't? This is very important for you to understand. And then, possibly some red flags. So a lot of hot topics that we want to be covering with you today. With us today, we have Mr. David Greider, who is our Senior Vice President of Sales. Myself, Albert Martinez, who is your corporate trainer here at Home Express. And we have Fernando Zuda, who is one of our top RSMs here in the company as our special guest. So with that, Mr. Greider, I hand it off to you, sir.
Great. Well, thank you. I love starting with polls, Albert. Can we start with a poll? I'd love one.
I know how much you love them. So
I do.
let's go ahead and let's ask the masses and let's see what they think. So what is your prediction on how big of a rate cut, right? How big of a rate cut do you think the feds will make at their next meeting? Do you think it's going to be 25 bips? Do you think it's going to be 50 bips? Or Powell is so late that he won't cut rates this meeting? What say you?
Wow, I love the options. Yesterday, I was thinking 50. After reports and seeing what today is 25. I'm going to go with 25. That's what I think. But I actually think they're going to need three rate cuts this year for a total of 75 basis points. That's just my opinion. Um, but it's interesting, right? So the good news is like given all this talk, the media and stuff, mortgage applications are on the rise, and more specifically in the refinance arena. So let's see what they say here. All right.
25. 25.
25. Okay. I
25. 25
very
seems
rarely am I, kind of accurate on this, but they do their own thing. I thought they should have cut 25 the last meeting, but yeah, they didn't do it. Right.
I was late.
Well,
So,
let's go ahead and look at, I think we're going to start out with DSCR history, right? And I think it's kind of important to kind of look at where this program goes, right? And this is one area I loved how Fernando Zuda w wanted to kind of join in here because he's been in non-QM about 11 years now, right? And I've been in about 10. And Home Express is 10 years, right, of doing non-QM. But this program was not available back in 2015, 16. There were some type of caveats for outside Dodd-Frank, but it really wasn't out there. So I wanted to kind of go through how conservative it was, how it started, how it performed, and why we can have some of the guidelines that we have today, right? And I kind of simplify what is DSCR on the business purpose side. It's just using some commercial tools simplified for the residential investment market, right? And these small to medium investors, they understand, hey, that part of the portfolio, besides stocks, bonds, and that is hard assets, which would be real estate and hopefully get some cash flow on. But we started with DSCR being had to be at 1.25. That's a lot of difference than what it is today. We considered, hey, there's an expense vacancy factor, right? You have that in agency. They have that expense vacancy factor. So this was about 2017. This go had to have reserves. We only use long-term rents. And on a refinance, we had to get a copy of the lease agreement, right? And proof of receipt. Um, and we kind of saw where there's some home value, especially in 21, that they're kind of stable. Rents had a little bit of an upward trend. And these performed very well. That means, low delinquency, low losses, and that. And I kind of look at where did these borrowers go, the small medium investors go get loans before this product? They didn't quite fit the agency programs, so they had to get private money. And that private money is typically 10+% points with a balloon they had to refinance every year or two. So this was an underserved market, and this was kind of the first entrance. Fernando, we'd like some comments because you were out here in 2014 in the non-QM space. What you seen on this product and what kind of going with what it is today?
Yeah, absolutely. Like you said, when non-QM originally came out, this product wasn't even available. It wasn't something that was available to the market. We, as an industry, tiptoed into it. Like you said, there was a lot of hoops you had to jump through. One of them that's not on the list is you had to be a seasoned investor. You couldn't just come in and say, I want to buy an investment property. Where do I fill out the application? You had to show that no, this isn't my first property. I've done several of these. I know what I'm doing. I got the formula figured out. There was a formula, and it was a lot more complicated than the formula is today. Fast forward 10 years later, the market has really applied a stress test onto these types of products, and they've passed. And if you're not currently originating these types of loans, DSCR loans, business purpose loans, this is a great time to get into it because you don't have to go through the bumps and bruises and the rocky road of getting to this point. You just get to enjoy this streamlined platform that we have to get these loans through. And if you just kind of check all the boxes, they get done, and they get done quickly.
Thank you, Fernando. Well, let's take a
Absolutely.
look on the next slide, kind of what that looks like today. And it's kind of like, wow, right? But as Fernando said, it did pass the stress test, right? Will we have another stress test with this program? Yeah, I believe so. We're coming into one. Everybody saw kind of the employment, the rent, that, and we'll see how this passes, right? So, but typically these borrowers have pretty good credit. They're looking for the cash flow, and the LTVs are skin in the game on these, as I call it, right? So here's some of the enhancements we've seen and kind of where we're at today. Now the DSCR is 1-to-1. No expense or vacancy factor on these long-term rental ones that we do, right? And that's for the highest LTV and better pricing. You actually get some credit back if the DSCR is over 1.25. It's a little bit less risk, but for the most part, if you're at 1-to-1, you kind of know what hey, I do this LTV, here's the rate. So this is a real benefit for our small to medium investors, for our real estate agents, all those type of things. The other thing that came out over the last 5 years is short-term rentals. So that's now part of that. And I'll go a little bit more how that works. But these are in the resort area, right? Mountains or on the beaches, high density where these do it. And we have a lot of small to medium investors that have purchased these, either condos or some SFRs or those type of things, and have realized some pretty good returns, right? Um, and the property types expanded, right? Non-warrantable condos, condotels. We even do rule on these, and we streamline the guidelines to make it easy for you. When you look at that, hey, what are some of that? Seasoning's one of them, right? And that's seasoning on funds to close, property seasoning where we can look at those, look at doing the loan. Less documentation required. So now on a refinance, right? We can only use we're allowed to only use the market surveys, right? Your 1007 or 1025 of its units. I'm not requiring the canceled checks and the lease agreement and proof of receipt, all that stuff. So it really has helped out streamline this so you can get us a loan. It can close right away on time and pretty good out there for you, right? All right. So as we're going into this, I thought we'd take a look at the market, right? Well, it's so great. We got these programs. Is there a market for it? And I'm going, most of you guys on here have been doing it. Absolutely. You kind of know it is. But the small investors on this chart right here accounted for nearly 60% of all the investor purchases in 23. And that's kind of the on the lines here. Again, this might be hard to read, but everybody here is going to get a copy of the deck. And so when you look at that, of all the investors purchasing out there lately, right, or past few years, the biggest percentage is the small to medium investor, right? So that's good. That means there is demand for this product. It's out there. Let's take a look a little bit further where this demand is at. So Albert, let's go to the next slide. And this kind of like looked at that, where are they going? And the reason I kind of want to put this out there for the trends is that not all these states on here you have to be NMLS licensed for to originate loans there, right? And so that's big. So some of these on here, I just took out, there's the trends, Missouri, Oklahoma, Kansas, Utah, Georgia, Montana. You kind of read those down the list. I don't know about Wyoming. That's a small population state, but wow, that's a big percentage of investments. I love Wyoming, by the way. I got relatives that live there. Beautiful area, but very cold and windy in the winter months. But as you look at this, I think they're looking for, the ways where properties cash flow, right? Where are they cash flow? You have to look at, just not only home price, right? So these are areas probably the home prices are a little bit more better on how to purchase that and get some cash flow. You got to look at taxes, got to look at homeowners insurance, right? I think that's why you don't see like Florida on here on the trend, right? Or maybe Texas that's got a little bit higher on taxes and some insurance issues as well as that slowed down. So they're heading to these type of states. Great places to market when you see trends like that. Now let's look at another kind of chart here I have for you. This is total investor buyer activity, right? So this is all of them. That's the large investors, including the small to medium investors, which is about 60%. Well, it's off the peak, right? So this line is just going through like 2001 all the way up, and we can see where it's heading up. We're down a little bit from the peak, but it's still 13 to 14% of the overall purchase market is this. So at 1 out of 10, 1.5 out of 10 transactions are still these on the purchase side of the investor loan. So very important to have some of these tools out there to provide to your clients and to your real estate agents. All right, so let's go into some basics of DSCR, and I'd really kind of call that, but how we look at these loans or how they're underwritten, those type of things. So it's based off the credit of the borrower and the cash flow of the property, right? So that's what we're looking at. Someone that, hey, got to have a credit standard. And then we look at, so it's not a DTI file, it's business purpose. We're just looking at the cash flow of the property, assess the appropriate rate, LTV that can be done on it. I also put on here income because we do these as income. They can be a DTI file as well, a little bit better rate. And then you don't have to worry about the DSCR percentage get in, because when these get submitted to us, typically, and you're talking to them, you really don't know exactly where the market survey is going to come in at. So they get subbed in at 1 to 1, and then you're kind of making adjustments as they come in with the appraisal and market survey. And everybody's kind of close kind of to where it is. And then you can use a lot of the tools we have to get that to a 1 to 1, or get that price appropriate so you can close that deal. Property types, SFR condo PUDs, 2 to 4 units, short-term rentals, condos, and non-morbid condos. Citizenship, you can see down there, MPRAs allowed. Foreign nationals are allowed too. I think Fernando has some comments on foreign nationals there in Texas. Fernando, what's a comment on what you're seeing in foreign nationals in your region?
Foreign nationals are a tremendous market. Don't overlook them. I often am told like I'm the only guy who does them. I find that hard to believe because they're very easy to do. They're just slightly more streamlined than your average DSCR. And there's a lot of people that live and work abroad that want to get their money, at least part of it, diversified in another place, the United States. And there's really nothing more stable than, well, for the most part, there's nothing more stable than real estate in the United States. So it's a great product, and I definitely encourage everybody to pursue it.
Excellent. So if you guys have questions on that, please contact your highly trained account executive. We'll help you with that. But this is great. And we allow vesting in a business entity, right? And we see a lot of that. Everything we do in-house, we can review that. We'll just ask for your business entity documentation. We have a legal team that can do that and make sure the docs are done appropriately for you, right? So do that. So we'll go to the next slide. We're just going to go a little bit deeper into this subject before we hit some examples. So debt service coverage ratio, kind of went over that. Purchases use 100725. On a refinance, every appraisal on investment property has to have a rent survey, right? So you got to have one, whether you're using it or not. But if it's a refinance, you can use the actual rents if it's a little bit higher. And I kind of comment on this just a little bit on rent surveys, right? Appraisers have more limited resources to get the market data to put on their rent survey, right? Traditionally, they've gone to MLS, that kind of stuff, but these small to medium investors have other sources to get it rented out, right? So then MLS. A lot of them are on Craigslist or other things that they do on how they market for it, where appraiser doesn't get that. So a good help for you when you order the appraisals through the AMC, right? Here's some comps, that are in the area, right? We even have a tool on our portal, a retometer or rental meter that can give you put in the address, the bed bath count, and will give you some comps that might show up for you. So we got some tools for you to kind of look at that, right? Now in the calculations, I want to point out a couple things. We talked about the 1-to-1 for the long-term rents. With short-term rentals, we do have a 20% expense vacancy factor, right? So why do we do that? And it's really, we just have a common sense approach on how we underwrite and look at credit. One is the long-term renter. Usually the utilities in that renter person's name, they're there. You're not having a housekeeper come by once or twice a week to clean the place and the expense for marketing it, because once you're done, you got a tenant in there. That's usually what there. So there is more expenses when you have a short-term rental, and we recognize that, right? And we also recognize that short-term rentals are seasonal. And so we try to get a good average over 12 months for that calculation, right? Because if you're up in Aspen, Colorado, the short-term rental income is a lot greater in the winter than in the summer. And likewise, kind of the reverse thing on the beach. So just want to kind of clarify that. And of course, you can use income docs or even bank statements on its own if they're self-employed. We'll go to the next slide, Albert, and this is just to kind of give you some examples of that. And I'd like to have that part of the deck as you guys receive it, so that's just that tool to look at. But a lot of different ways to use the short-term rental, right? The only concern I have, make sure it's in a high-density area, short-term rental, where they're typical. Very hard to do and get the data necessary to do that loan. You might end up saying, hey, what is it on a long-term rent? So that might be your best avenue on getting that done, even though they may use it for short-term rentals. All right, we'll go to the next slide. And some of the highlights for you, right? So borrow may own unlimited properties. That's pretty huge, right? Where did they go before this, right? So they could own 20, 30, 40, 50 properties, right? And we'll do up to 10 loans to the same borrower at one time with a 4 million aggregate. Again, these are non-trid, so they're outside of Dodd-Frank, they're business purpose. Don't get into all the CDs, LEs, notice of intent to proceed. You can order the appraisal anytime, right? Since you're outside of that. We also allow a kind of, you could tailor loans based on dual comp or a variable lender paid comp option, right? So you can tailor the loan to that borrower based on, hey, they want a certain rate or these type of things or costs or money down. You can able to tailor that for what you're going to charge them on borrower paid and lender paid and have that variable, right? On this line of cash out refinance, but what's be used for business purpose, I am big on compliance. This is business purpose outside of Frank. So if the cash out is going to be used for consumer purpose, and I'll give you an example, I'm going to refinance my rental property, pull out a couple $100,000 to for my down payment on my primary. That now is a TRID loan because the use of those funds is for consumer purpose, and you have to afford TRID, which we have that option available, but it would be a DTI loan, right? No prepayment penalty. That you have to go through the TRID, and that would be your LE notice to proceed, notice intent to proceed, CD, right? We do DSCRs even below 0.75. Pretty aggressive. Minimum FICO to get in is 620. Talked about the vesting in a business entity. And then we're going to look at the states available to do business purpose with no NMLS requirement on the next slide, Albert. There it is. So everything in the dark blue, no NMLS license is required, right? The lighter blue, those are required. You can see there's 4 states. We're not yet licensed in to do business, but I'm sure over the next year or two we will be looking at these other states, right? But we have a big footprint across the whole United States and Alaska and Hawaii. So got this for you for your marketing or purposes on that. Okay, so I talked a little bit at the consumer purpose. Don't have to go on that. All it is, it's a TRID loan, right, with options to do bank statements because the purpose of the loan is for consumer purpose. So you can look at that for that slide. But for time, I think we'll go in probably, hopefully have some examples here, Albert, coming up.
We do have some examples, Mr. Kreider, but before we get into the examples, it is Thursday. We know that,
Thursday?
it's
Is it football season?
There's
You
football.
got to have a football
It is.
poll.
There's football tonight, so there is Thursday night football. So who do you think is going to win the Thursday night football?
Oh, I got to go with the Packers. They're home, man. Come on, Packers.
Yeah,
Of course you
a
would.
Commanders fan, right? Like, I mean,
No.
come on.
No,
I don't know who
I
is a
got
Commanders fan.
Especially if you live in California and you're a Commanders fan, like how does that work
yeah,
out?
that's a little rough, right?
It doesn't make any sense.
It does.
But
It
all
does not make a lick of sense. Yes, I agree. So the masses are speaking, and yeah, I tend to agree. It looks like the Packers. The Packers
Well,
are.
I didn't see the result. Did you see it up
I
there?
am
Oh,
about
there
to
we go.
post it
Okay.
right now. Yeah,
All right.
63%.
Hey, we
It's the
got a
Packers
lot
are
of
gonna
it, a lot of smart people on this call, right?
win. A lot. I mean, there's maybe like one or two that think that the Commanders are gonna make it happen.
Awesome.
We know
Awesome.
one guy.
Yeah, we do. Yeah. All right. So let's take a look at some of these examples, and I can maybe have Fernando kind of explain some of these. And these are real deals that came in here in how we're approaching these. So Fernando, like to take over here on some of these examples.
Yeah, absolutely. And the first example, the very first thing I see here is a 3-unit purchase. And the first thing I think, and keep in mind, I've looked at hundreds and hundreds of DSCR loans, before coming on this call, after this call, I'll look at them all day long. If I see I got a 3-unit purchase, I know that's going to debt service. And it's going to debt service well. The more units, the better. We do 1 to 4. So 3 is a great number of units, and you could tell the market rents are $4,800, and the PITIA is 3333. And without even having seen those numbers, I knew that one was going to debt service. Also, in this particular case, the borrower opted for a 1-year prepay. My guess is that they're going to have this, they're going to get this loan, they're going to get everybody settled in, they're going to have their tenants, and then in a year, if the market turns and the rates lower a little bit, then they're going to refinance and take advantage of the lower rates, which is smart. It's smart for them to do that. So this is a great deal. Slam dunk.
Excellent.
Yep.
Let's go to
What
another
else we got?
one here.
What else we
Yeah,
got?
here
There
we
we go.
go.
You've talked about this a lot, and this is a great example. And again, I've looked at so many of these, trial and error. Please learn from my experience. I'm looking at a property. It's a short-term rental in the Florida Keys. Right? Somebody's on the phone talking to me about this deal. I like what I hear so far. The PITIA is $5,400. They're using AirDNA to qualify in a short-term rental. And of course, it's going to qualify. It's in the Keys. It's on the water. And again, you have that conversation with me over the phone, and I know that this is a good deal. And as the numbers kind of fleshed out, it's 1.16 DSCR, 80% LTV, all day long.
All day long.
Loans like these are great. I love to pick up the phone and have these phone conversations. What else we got?
What else we got, Albert?
Same thing, right? What's a condotel? That's the original short-term rental, right? Airbnb, Verbo just kind of made it a little better. This is really the same thing. It's when you're looking at a short-term rental, if you come to me and say, hey, I'm in the middle of suburbia, with not a lot going on, you say, I want to do a short-term rental. We could do that, but that really sounds like a long-term rental. A short-term rental is, they're, like you said, they're on the mountains, they're next to the slopes, they're on the water, they're truly destination places. And this is a perfect example. This is the purchase of a condotel, $1.4 million, 75% LTV, but it's in Park City, Utah, and I guarantee I could see the mountains behind it. I guarantee this is some type of resort destination where people go. It starts snowing and people are hitting the slopes. When I see that, I know that that this is a good deal. It's all going to flesh out. I don't know what the numbers are as far as the how the DSCR fleshed out, but I know it worked because it got done in less than 30 days. You submit it on the 1st, and you're closing before the end of the month and collecting that paycheck, and that's really what we all want on a day-to-day basis. One thing I would like to point out, David, is these are good deals. These are slam dunks, but there's lots and lots of, like you said, Oklahoma, Utah, Missouri, Wyoming, all over the country. They don't always have to be a $1.4 million loan. More often than not, it works better with a $300,000, $350,000, $400,000 loan, 80% LTV, right? A fairly low PITIA, and then that you're going to be able to rent it out for a reasonable price, and they're going to debt service. You're not always looking for the home run. You can make a really good living over and over again with a $300,000, $350,000 loan. And like your chart said, there's lots and lots of those, and they're being purchased by individual small to mid-size folks, 1 or 2 or 10 or 20, so this is a robust market, and you should certainly take advantage of it. So
Right. Well, thank you, Fernando.
absolutely.
Let's go to the next slide. And I always point these out, some red flags, right? And the reason for that is just kind of be aware of what's out there and some of the compliance things that we see. And I try to provide those for you, right? make sure we're not circumventing TRID loans, by putting borrowers on here where we shouldn't be, right? These are for non-owner occupied only, right? So if you see that, we have programs that can fit. We have lots of flexible consumer purpose programs for you. So put on there. Um, Other things we've seen recently listed, and you look at it, the intent is to sell the home, and then the lendable value could be questioned and all that, and all of a sudden they want to refinance it, but there's no tenant in it, and but they had it listed for sale for 6 months. Now we don't say no to that. What we do is like, hey, I really think you might have a valuation, and what I mean by that, I've recently listed the home for 300,000, had a few reduction, and then you want to use appraisal at 350. Well, that's pretty difficult to do if it's listed and didn't sell for a lower amount. So get with your A on that. We're not going to say no because fair enough. I mean, hey, in the market that they're in, maybe, hey, it's not selling. I'm gonna hold on to this property for a couple years. Absolutely. Could be a great decision, but we got to make sure you're looking at the right valuation on a refinance based on the current data that you have, and you look back 6 months of what that listing price was, right? Other thing to look at, and we don't say no to this, rapid value increases in 12 months without substantial improvements. Now, I'm just going to say here's the concept. How do home values increase, right? In general. Home values increase due to two things primarily. One is time, right? Another one is by improving the property, right? And so if you don't have those two things, why did it go up? So we just need to explain it. Maybe they got a good deal. With that, we don't have necessarily a season requirement to even do a refinance on on the property, but we're going to look at that value. Does that value make sense? And some of these get a little bit more heightened review based on that. So when you look at it, I'm just going to point this out to you as you're talking to your A. What was that? Kind of look it up. Here's what we're trying to do. Other items to take a close look at is unpermitted additions, ADUs, right? Um, you kind of think it's silly, but we've had those come in. Hey, they're renting out the ADU. Great. They just put it in last year. Not a problem. It doesn't show up in title report. How'd they do it? Oh, they built it themselves. Well, that's a little bit difficult if you don't do the proper permitting through that local jurisdiction, right? So just ask permitted, so we can use the additional rents on those properties. So I just tell you what, because I do a lot of training here with our county executives. There's two things I look at on properties, and then I kind of filter after that. One is marketable, right? Is this marketable? And we kind of hit a little bit, as Fernell talked about, short-term rentals, being on the water, up in the mountains. That's a marketable property for a short-term rental because people like to go there. Me, if I take my family, my grandkids out, do you want to go to a hotel or are you going to rent a home where everybody could be at? Those make total sense, right? To go on the beach or the mountains or those type of things. But the marketability for that somewhere else may not be there. The next one, is it legal? And this is part of that example here that you kind of need to be legal on the property, all right? So another one here is kind of get asked this occasionally on vacant properties. Now, there's a couple of reasons why a property be vacant that are probably okay. One is the purchase, right? I'm purchasing and the property, well, they don't own it yet. They can't even rent it out. Those, we understand all that. Those go through and from. But what if it's listed for sale? Oh, now I'm going to rent it out and improvements were done over 6 months ago and it's vacant today. Those could be a little bit difficult to do, right? Generally, homes are kept up better if they have a tenant in there. They're safer. Their homes are down a little bit. So and you don't want squatters going in there and all the risks associated with that. And so I'm just saying, just be careful of those as we go through it, right? So with that, I think we'll keep going on and go through this matrix. This is just on here, part of the deck, so you can look at what's your max loan amount, right? Yeah, probably that's a question. That's 2.5 million. LTVs, we go to 80% for cash out and purchases, both, right? And so we do have some great programs for your borrowers. Talk a little bit about non-delegated correspondent. This is something new we came out. So it is for non-QM loans. So if you're currently at a place that prefers the correspondent channels, we have that available. We have no carve outs on our programs. You still work with the same AE and have a little more flexibility, as you know, if you go correspondent on the way you price deals that way. So if you're on a place, please let them know. We would love to talk to you about our non-delegated correspondent channel. We'll go to the next slide. There's just some data here for you how we do it. But we'll go into the next slide here, coming up on 30 minutes. Great. So now, I guess, Albert, let's see what questions we have from the audience or maybe comments.
Yes, sir. So we did have some questions here. So the first one comes from Gary and says, seasoning is for reserves or cash to close?
Okay, those are two questions, right? So the funds to close is, believe it or not, we have on a purchase, or I guess it could be cash in on a refinance, is 10 days, right? That's in their account. Reserves are seasoned 30 days. So traditionally, you want 60 days seasoning on everything. We've really streamlined that down for reserves 30 days, funds to close 10. Really really helps you out. And the
Awesome.
seasoning also was on property, right? We call value is value, right? But you probably have to go different reviews, right? Oh, you got to wait 6 months to do a refinance. No, that's not true. But the value is going to be looked at. What they buy for, what the improvements do, is this value realistic? And we're going to go through that review process. Don't let that slow you down. So we don't have necessarily any seasoning. They could have bought it last month. But what did they do to it? Remember, the time and improvements are what we're looking for, right? So don't have much time. What improvements do they do? Well, tell me the circumstance of this loan, right? So just share that. We're common sense. Tell us what deal makes sense. We'll probably close that.
Awesome. Thank you for that. We do have next one says, do you accept Venezuelans for NPRA?
The answer to that is yes, we do. There's like one country we don't. I think that's Russia right now.
Russia,
Yeah, but the rest of them we do. Yeah,
maybe Iran. Yeah.
yeah. But we look at it. We're going to run, the safety check and all through OFAC, all that stuff per borrower. So that borrower that's coming in, we're going to run through OFAC.
Awesome.
And they'll need a valid visa and an EAD. That's a statement, I guess.
Awesome. Thank you for that, Fernando.
Yeah.
Next, so you can pull money from a DSCR to buy a principal residence?
No. So I'm saying
No.
is since you're going to go buy a principal residence, that is not a business purpose loan. So this whole program is not for that borrower. That borrower needs to go into a consumer purpose program, okay, where we're going through TRID and DTI. Okay, so I'm trying to clarify it because I've seen loans come in and maybe people aren't realizing it, and then the cash out, they do a LOE for the cash out, and the LOE says, "Hey, what are you doing with the cash out?" "Oh, I'm going to use the proceeds to buy a new primary residence." Well, great, you're on the wrong program. This is for business purpose, and then we have to resubmit it in. As a DTI file, right? And go through the LE, notice to intent to proceed, and all that, because the purpose of the loan was for consumer purpose.
Yeah,
Awesome.
and can I add,
Yeah.
just if it's a DSCR loan, it falls under business purpose. If it's business purpose, the proceeds from that loan have to be used for business purposes. And if you just kind of go down that straight line,
51%. Yeah, 51% of the proceeds has to be used for
there
business
you go.
purpose.
Thanks.
Next is from Daryl, and it says, what about for properties used as co-living?
Co-living.
Not sure.
Like a
Like a
2-unit where,
co-op? Like a co-op? I'm trying to go as a co-living. So is that like, because there's a couple things. One is you have properties, and I've seen these in some nice, got more urban areas where it's got a little storefront below and you live on the top, right? That kind of stuff. That's what you mean by co-living? Or is it, we don't do co-ops. right? Those type of things that's not a product we have, but we'd certainly look at that. Is it marketable and legal? We would look at that. We understand you're going to need like comps like that where we can see where this is there. Generally, if you get into a lot of the mixed use and you're looking at those things, you want no more than 30% of the light commercial influence on any of that, any of those properties.
He added some context. He said rented by the bedroom long term.
Well, bedroom, room rents, right?
There you
They
go.
could be okay. Now, room rents, right? We can look at those. I caution you as why the room rents are there, right? Because typically room rents are short term. And so you need a little bit more history out of them been doing it. Also, when you get to room rents, what is it? Is it a care facility? Right? You get into those. Now, I don't say no, kind of let us know what it is, right? How's the property been modified, right? Those are things we look at. Now, I'm not saying no to you because there's cases we have done those loans where they have room rents, right? I know a lot of cases we have. Property's not modified. They explain what they do. Great. Okay, we understand that and go for it. But if you're going to bring us something that has, hey, it's a adult care facility, we're not even saying no that. We'll take a look at it and see if this makes sense. It's something we can do. But a little bit more difficult on room rents, but they can get done. So you kind of show us what those are. They've been historically doing it. Great. We might need a little more data on it. That's where it comes. This is probably more documentation.
Hey, David, I see these a lot next to colleges
Hmm.
and college towns where, oftentimes they're very nice, but, there's 4 bedrooms for 4 students and there's a common,
That's fine.
kitchen and they, it
Those are
tends to make
perfect.
sense in those situations. Not all, but
No,
those situations.
no, that totally makes sense.
Mhm.
Yeah, it
Good,
looks like
good investments, right? For your small
Yes,
medium investor.
absolutely.
Absolutely.
yeah, it looks like they added some additional context. That Pad Split is a name brand of co-living, if that helps with context. Um, okay. Then
I'd
Yeah.
have to dig into that one. For me, it doesn't
Yeah, I mean,
resonate.
I've heard of them. I've seen them, and we've done a few before. I'd have to look at that scenario. The good news is you can get to one of our account executives. They have access to our credit department, and so they say, Give us the property you're trying to lend on. Explain it to us. We can give to our credit department on it. They can make exceptions on it. Hey, this makes sense. And so I've seen some of those pad splits get done.
Awesome. Next, Karen added, she said, there's a newish trend where rooms are rented out with common living areas. Fernando, I think to your point, no owner living there. NYC has a lot of these.
New York City.
Well,
Okay.
Sir,
Well, you look at it, and I think, just like we saw the trend with short-term rentals come out over the last 5 years, with the affordability and inflation that has happened, I think you're going to see a lot more, if I'll use a better word, co-living. That makes total sense. And us as an industry should look at that and say, hey, this probably makes sense. We can use deductive reasoning or, logic and say, hey, this is a good loan, make sure we can get comps for that. That's the main thing. So it's marketable and it's legal for a jurisdiction. We'd certainly look at that. Now, presently, we're not licensed even on business purpose yet for New York City or the state of New York. We'd love to be in there. Our plans are to be there in 2026 at some time.
awesome. Looks like someone wanted to let us know that the stubborn Bears fans cannot vote for the Cheeseheads no matter what. So
I totally get it. I totally get it. We do a football pool here too, and then one of our senior VPs said, "Well, who won week 1?" And he's a big Chiefs fan. I was going to email back, San Diego won. Didn't you watch the game? Kind of crazy.
that would have been a great one.
Yeah.
Um, so Umberto wants to know, do you accept gift funds for MPRA?
So we do have gift funds available for even on these DSCR ones, right? But here's the reality, right? I just want to think about this. Our funds to close, you need 10-day seasoning. Okay. That's all we go back. So why would you need gift funds? They put in their accounts in their account for 10 days, boom, we're going in there. Let's say that doesn't happen. We do. We have, you put 5% of your own money in, right? That we can do that. You can allow for gift funds. But I'm just saying, given our rules, and we understand that there's a lot of families and stuff that might pitch in or whatever, or they have business entities and they're mingling, hey, I'm going to transfer from this LLC to this one, and they're doing all this for the cash down, right? And that's why we went to 10-day season. We started going, man, we're tracking all this stuff and making it difficult. Just get all your money in there before you close 10 days prior. Can you do that? Boom, we're clear to go. We know you got the reserves if it's required, right? We just go back 30 days on that for your 6 months PITI if it's required, or it could be 3 months now, right? Most loans 3. You're good to go. Right. So we're trying to make it as easy as possible. So you don't need to go out. Now I need to get a gift fund letter from here and there. Man, 10 days. Just put the money in that borrower's account whoever our borrower is, you're good to go. Very easy.
I always say just drop the money in and pull a 10-day transaction history. That condition's cleared.
That's correct.
There you go. Hopefully that also answers the question for Umberto, where he's saying, will the money for closing get sourced?
No,
It's
that's what I'm
seasoned for
saying.
10 days.
That's it.
Yeah.
10-day season.
Yeah.
Bam. So we're trying to make it easy for you. Now, when you look at, well, why would you do the credit risk? Well, we've seen enough of these from, being in the business for 10 years, how that money gets in there, and then you go on that. And believe it or not, there are borrowers out there that leave money in their safe at home. And then they can put it in 10 days before. And I've had many cases of that through my career in non-QM where they don't trust banks. I want 100 grand in my safe back out, right? Especially if I live in Texas, right? I want my money, right? Right, Fernando? And then, okay,
Guns
how
and
do you
money
source
and the
that?
Cowboys.
Okay, just kind of get it in there in the account there, right? So, and then they have other sources, right, to come in there. Maybe it's done different. What if you got 3 or 4 people in LLC, small percentages here and there, and they're pulling money? Just pull the money 10 days before to one account. This is the one we're using for the down payment, and here you go. Try to make it easy for you so you can plan ahead. And I'm for one. I mean, I bought a house like 3 years ago, and part of it is like I always knew people know where they're getting their money for the down payment. And I was saying, can you just do that 2 weeks ahead of time and get that, and your life is easy.
Okay. Next, I'm gonna hop over to the Q&A because there's some in there too right now. So any chance you will be doing 5+ units again? Big need in the market.
I think so. It's been on our credit committee. I'm part of the credit committee, and we're looking at that as we speak. We understand the demand that's out there, right? Especially as you look at the affordability, those type of things, that it's a good market to be in. So we are looking at getting back into that.
Okay. Next, are there any number of months seasoning on a DSCR before it can be refinanced?
The answer to that is technically no, right? So they got to own it. However, you could have some valuation problems, right? That's where I'm trying to go. So in our guide, it's not that. It's like, what is the property worth? Can they explain to it? And what we'll see is you just can't put it in somebody's name and say, now I want to cash out and do all that. It makes sense, right? So they purchased it, right? And here's your purchase. Here's what they did, and now here's their improvements they made. Here's it, and they're buying out. What you might have is a valuation problem where do you have a loan enough equity, lendable equity? They could have it, could be worth whatever. What we have to say is a reasonable test for lendable equity to make that loan work. So, so it's really a valuation test.
Dave, I see this a lot when somebody pays cash and they pay cash, they want to recapitalize. They didn't want to lose the home. They pay cash, they want to recapitalize, and then they do a refinance.
That's just
usually with-
delayed financing. So it's kind of like that. Delayed financing is available on this product. But what typically I see is like, hey, it's 60 days ago they bought it. They have a crew. They come in. They tear out the walls, put new sheetrock up, do everything, put all new appliances, new flooring in, and the price has gone up. Now they want their money back out, right?
Mhm.
That makes sense to me. Okay, they bought it for cash because it's not lendable for our standards. They fix it up. Now they're marketing for long-term rents. Here's what I put into the property, what I paid for. Here's what put into the property, and they like their funds out. Great. That makes sense to us, right? They want their money that they put into it out. Now, if you want a whole bunch of cash out on top of that, that's when you start getting some valuation. Yes, we would definitely look at that, but make sure the valuation makes sense.
Awesome. We have a question here. It says, if a husband and wife are applying for an investment property to close in the LLC, but the wife is not on the LLC operating agreement, do we need to add her to the operating agreement?
Man, you guys get technical. Fernando, you want that one?
Okay, yeah, sure. So you you're purchasing a home. The husband and the wife are on the loan together. They're closing in an LLC, but only the husband is on the LLC, not the wife. Is that the question?
I
Yeah,
believe
and then
it's-
and then if the purchase contracts probably has to be changed, right? That's I look is like who's buying the property because if you know if they want to buy it, so then you have to change it to the LLC, and then it's going to be vesting in the LLC. Then the personal guarantor is going to have to be the one that's on the LLC. So. Does the wife want to be on the loan? If you want to be vested in it, why wouldn't she be part of the LLC and be put on there? So that's what I'm looking at. I don't really see where that'd be an option. Of course, the wife put on the LLC if she wants to do that because, but she could be out on after the fact for the LLC. So we're looking at the LLC documents, got to match right. So so the purchase contract matches the loan docs, matches the title policy and the HOI, all that stuff that's got to match. And then the question is whether the wife wants to be on the loan or that's well, this,
To, to me,
I
the
don't
real
think she's,
question is
yeah.
why would you want to be liable for the loan but not own the property?
Yeah,
Right? So my guess is she's going to want to be on the LLC.
LLC. Yeah.
Yeah.
And you can put her on there before or after or right, during a
Yeah.
transaction, spouse, right? We get that. All right.
All right, here we go. Next one, asset depletion guides versus DSCR. We can treat asset depletion as non-QM.
Okay, so we have asset utilization, which we call Asset Express, on our consumer purpose. We have not added that into the DSCR. Now, there's a few lenders that have it, right? And so we're trying to figure out what is best to do on that. Where, hey, my DSCR is below one. They have all these assets. You divide it by 60 months, add that into it in the DSCR. Magically works, and you got a small add to the rate, but you get the LTV, right? And that's kind of what that program is. And then we're asking the question, right, of like, is that a good loan or not? Well, part of it is because, if you're short on a DSCR, right, the cash flow of the property is negative, right? Well, how are they going to make that up? But well, they got all these reserves, so that kind of makes sense on a spot too. But also, if the market turns, let's say the market turns, so you got the higher LTV, they can't find a tenant, and the property values go down in this particular area. Do you really think they're going to use their reserves they have here you did to make up that payment? Some would, some won't. I think this is one where we're exploring where does that make sense? Because I think it makes a lot of sense if you're short on on your DSCR, like a negative cash. Hey, I got all this money. Where are you getting that money from to make up that difference? That makes sense to me, right? So we don't have that on here. We have asset utilization, which we call Asset Express on our consumer purpose, and we're looking at ways to incorporate that into our DSCR programs presently.
Awesome. Thank you for that. Renee asked, but can they go buy another rental property?
Yeah, yeah, I think that was on the cash out. Yeah, absolutely. So that's a business purpose. Buying an investment property for the business of rental properties, that cash out can be used for that. Absolutely. That's very typical of a loan we get in. on a DSCR. Cash out was cash out. They're going to go look and use that money to what? Buy cash on a property that they can improve, then over that, get a new tenant in there and kind of do it again. We've seen that quite a bit.
Yeah,
Uh,
usually it's fixing, improving a rental property or purchasing a rental property. You say either of those two, and you've answered the question correctly.
awesome. Thank you for that. So we have here from Sherry. With this accelerated program, does the borrower incur a higher interest rate rather a higher interest rate than a similar DSCR option?
Man, our rates are pretty darn good. Right? If I look at the DSCR rates today, we can share that with you. We're actually on Lender Price and Loan Sifter. And if you go into it, they're pretty aggressive rates. I think what's our floor today? 6.25, 6.125 on a DSCR loan, right? Again, that's a high FICO, low LTV, but a lot of our loans are way better than on our DSCR than traditional financing would be.
Awesome.
And here's my contact. We'll send you rate sheets if you like to look at those. But better to use a portal for pricing, right? And there's pricing, I think, available on our website.
And if you don't have access to our portal yet, you could get with Mr. Grider, you could get with one of our account executives, and we'll get you access to the portal.
That's right. Don't even have to be approved with us to have some access and flexibility to see what the portal looks like. Just not able to submit until you're approved with us, but you're able to access a lot of that information and pricing.
So Danny has a few questions. Okay, so first, do you have requirements around rural properties?
Yeah, I'll talk about rural properties for a moment, right? So again, the two concepts on properties is marketability and legal. Okay, now how rural do you go? So I say we do rural properties, we don't do remote. Okay, and then we have a small, you just don't go to the max LTV. The LTV gets capped a little bit. I think 75 on a purchase, so you go minus
75, yeah.
5 in LTV. Because the marketability for a rural property is less than a suburban or urban, just less population, right? Less demand for that particular property. That's why you have that, right? And what I mean by not remote, if they're a home up in the mountains with the nearest stores 2 hours away, there's no employment, there's no medical facilities. That gets pretty remote, right? That probably not. Who would buy an investment property for there anyway? So we don't see those, right, that often. But there's some great rural, what we call rural areas, just because of population of that it makes sense. People need to have a home there. There's working close by. Maybe they like to have more of a land. We totally understand that. It's just your LTV's capped a little bit.
Within our guidelines, there's a definition for rural. And, like you said, sometimes it's like out in the middle of nowhere, but sometimes it's not that far away. And what I usually do is I say, how far away are you from a Starbucks? Because if I want a Starbucks coffee right now, there's like 10 of them within walking distance. If you're 20, 30, 40 minutes away from a Starbucks, that's probably too far out.
The next question is, do you take borrowers mid-score?
Yeah, we do. That's how we use it. So you look at the credit of the borrower that's doing the personal guarantee, if it's in a business or that, or how that's set up. We use the middle score of the borrower, right? Yeah. That's what we do.
And if there's two borrowers, we use the higher of the two. The husband and
That's
wife,
true.
they're purchasing, we use the higher of the two. If you're using income and it's 50-50, like they're 50-50 business owners, we're going to use the higher of the two as well. So that's a good Home Express thing we offer.
Yep.
So it
Lots of
looks like a
flexibility.
combination of that. In a multi-member LLC, if a borrower has 20% ownership with the higher mid score, can they sign as the guarantor on the loan?
They're 20% owner of an LLC. Boy, this is like an SAT question here.
Yeah, it's a little technical, right?
Yeah, and again, this is, the concept is this is a structured loan. It's like I'm going to structure the loan to fit the guidelines or call it what it is. And I believe you call it what it is. who is the main person on this, right? Because the signer of the LLC can be totally irrelevant, but the one that we're lending on, can we lend on the person that makes most of the financial decision? Doesn't that make sense? Now you're going into, well, I got 5 members of LLC. This one's got better credit, but it's very remote. That has nothing to do with the business. Oh, okay. Well, okay. I get that. I think that's done today. So at 20% or more, we're probably going to look at that. There's cases where you look at it, we might need 2 people or 3 people based on ownership of it to sign, right, as a personal guarantee. Now, here's what you're going to do, though. You're going to provide this documentation to us, to your AE. They'll review it. We can review that and say, hey, this is how we can do this loan. This is who you want to sign. So we're going to clear up that for you right away at the beginning. So provide that documentation the way you want to do it to us. We have a legal department that will go through that to make sure, hey, this is the way it needs to be done. Here's how the docs will be done. Yep. And we got that squared away. So when you run into that, don't have to be an expert in everything. You don't. We have experts here that can help you through this process.
Awesome.
Yeah,
And
and
then
at 20%, oftentimes, I don't even think we consider that person self-employed, right? That person doesn't have like that much of involvement in it. So that's a tough one to answer because you're kind of answering in a bubble. We need to know more details on that one.
And it looks like Danny also wants to know, what is the max seller contribution for the DSCR loan?
Good question.
Let's take a look.
I
that is a good question.
think we changed that. Like it used to be 3 and now we allow 6, right?
It's three and 6 depending on the
LTV.
LTV.
Right. What we've seen, and these are, it's like it used to just be 3 max, right? So I kind of go through that. Then we looked at it and we're going, wait a minute. Lots of concessions in the new builds, right? Lots, right? Have you guys seen that, right? So we kind of adjusted that. Say, okay, maybe 75 and under, 6% seller concessions. At 80%, it's 3. However, we can look at that. Does the deal make sense, right? I'm going to tell you how, from a real credit perspective, outside looking in, right? Here's the purchase price, 500,000. Oh, by the way, since the new build, I'm going to give you $100,000 in credits of all kinds of stuff. What is the real value of that property? That is the question that they look at. Well, I'm just trying to get the loan down. But if you're given $100,000 in buy downs, furniture, cars, all this other things to get them into the house, and your purchase agreement says 500,000, but you got all the stuff added in, what is that real value? And believe it or not, there's smart people that do all this securitization goes through this. They're probably going to pinpoint that, hey, that's 400,000. Now, I gave you an extreme example, right? But I'm going to say, in theory, if you're putting a whole bunch of credits on it, really, what is that home worth, right? And that's kind of the principle behind it.
Danny just wanted to add, said, thank you. This helps me determine a correct lender when placing my loans. All right, Mr. Grider, we are very much on, we're over the hour. So let's have some.
For the hour?
Yeah, we are over.
Well, good. This was
questions.
great. This is why we do these. I try to keep them to max a half hour. So if there are questions on anything you guys want, I love addressing those for you. Do we have a webinar next month?
We sure do, Mr. Grider. And next month we're doing cash out options for non-QM.
And here we've seen a real spike in mortgage applications with a higher percentage on these cash out. So I'm going to try to go through all the cash out options we have available for you in the non-QM space.
Awesome. Thank you for that. So with that, everyone, we want to say thank you for attending another webinar. A copy of this deck and also a copy of this recording will be posted and sent out to you. We want to thank you again for your participation, and we'll see you in the next one. Bye, everybody.
Thank you.